How do reserve currencies cause historical trade deficits? Imagine a world where one country's money is used everywhere, not just at home. That's what happens when a country issues a reserve currency. Right now, the US dollar is the main reserve currency, but it wasn't always like this. Countries hold these reserve currencies to make international trade and investments smoother. They see the reserve currency as safe and easy to use for transactions across borders. When a country issues a reserve currency, it supplies the world with its money. Countries with trade surpluses, meaning they sell more to the reserve currency country than they buy, end up with lots of that currency. Instead of just holding onto it, they often buy assets in the reserve currency country, like government bonds. This process is called reinvestment. It helps the reserve currency country finance its spending, especially on imports. So, if the United States exports dollars to other countries, those countries keep the dollars as reserves. They then use those dollars to buy U.S. government bonds, which helps keep U.S. interest rates low. Because of this cycle, the United States can import more than it exports without facing immediate problems. This results in a trade deficit, which is when a country imports more than it exports. This pattern has happened before with other reserve currencies. For example, in the 1800s and early 1900s, the British pound sterling was the main reserve currency. Britain experienced similar trade imbalances back then. After World War II, the US dollar took over as the dominant reserve currency, and the pattern of persistent trade deficits continued. The reason this happens is tied to international capital flows. Countries want stability and liquidity, so they prefer assets in the reserve currency country. This creates a steady flow of money back to that country. It allows the reserve currency country to run trade deficits without running into the same financial problems other nations face. In simple terms, reserve currencies cause trade deficits because the country that issues the currency supplies the world with its money and safe assets. Countries around the globe hold and reinvest these assets, which helps the reserve currency country keep its trade balance in the red. This setup supports global trade and financial stability, but also links the reserve currency status with ongoing trade deficits.